Welcome, everyone. My name is Celeste Early. I am the Director of Development here at the Alaska Community Foundation, and I am joined with Kevin Gray, who is our Chief Financial Officer here at ACF. And for those of you who maybe this meeting is a surprise, we are going to talk about investment strategy options here at the Alaska Community Foundation. We're going to talk about how our investment pool works. Kevin is going to give a great overview of our investment strategy, our investment portfolios. And this is really important because once a year, you are able to change, if you so wish, your investment pool options, of which we have three. And so that election period is coming up between June 1st through July 31st. And so we want to give you this education ahead of time so that you can have an informed decision should you wish to swap your investment pool options. And with that, just for those of you who are joining us, I'll go over a little bit of housekeeping again. Please put any questions in the chat. We'll try to answer that during the session, or we'll save those to the end where we'll have a bit of an ongoing Q&A. And again, this meeting is being recorded so that we can share this out with folks afterwards, and those resources will be available on ACF's website. And with that, Kevin, take it away.
Well, good afternoon, everyone. Welcome, and thank you for joining us at 4 o'clock on this rather gloomy day outside, but thanks again. We'll go ahead and get started here talking about investments. So today we'll be discussing investment options for our fund holders. Oh, I've lost my notes here. Hang on just a minute and I'll figure this out. There we go. At the outset, there are three investment pools, two of which are long-term in nature, and they have investment horizons that exceed 5 years, with an even longer investment time horizon, usually 20 years or more in mind, generally. The short-term pool is largely reserved for time horizons that are less than 5 years, or where inordinate market risk would invalidate its purpose. So three of them, short-term, long-term, and the ESG pool. We'll talk a little bit about the long haul and what we talk about there. So let's talk about the short-term pool first. Again, it's set up to be largely less than 5 years. It's a short-term fund. Electing this pool will house your money in a money market environment. That protects it against any traditional public equity market risk that might come along. And that market risk sometimes can create a negative return of substantial amounts sometimes. And that this pool is really not expected to produce acceptable long-term returns that would meet endowment goals, for instance, but rather be a safe haven for short-term oriented funding. And those would be funds we expect to expend in maybe a 3 to 5 year period. So let's go on to the long-term investment pool. The long-term investment pool is designed to be here in some cases in perpetuity if you have an endowment with us. And you can see that our board of directors feels that the capacity to make future grants is just as important as ones that are made today. And we do that through some very conservative things within our investment philosophy. That investment philosophy is contained in the investment policy statement, or the IPS, so that we don't have to say that long word. And it emphasizes a long-term growth in capital while avoiding some excessive risk if we can, and that preservation of purchasing power, or in a better circumstance, preserving the contributions that are made to your fund over time. And so the perpetuity, we believe in the power of those endowments to create a lasting change for the benefit of Alaska. We're conservative and responsible stewards of those charitable assets. We demonstrate transparency, accountability, and provide responsible investing. We use diversification as a tool for that. We'll get into that a little bit more, but we use modern portfolio theory as a framework for assembling a portfolio of assets that the expected return is maximized for a given level of risk. We do that by using different asset classes. The IPS, investment policy statement, sets out the main asset classes and target allocations for those, and that is a key determinant in expected return and the level of risk we're willing to accept. And then the IPS empowers and restricts the investment committee to find acceptable investment managers, advisors, and sub-advisors, and allows the committee to define specific investments within those asset classes and their respective targets. So how do we do that? Well, the asset allocation looks something like this. So just to talk a little bit about the long-term pool, it's existed since 1995 when ACF became a community foundation. It's the one pool that we offered up until June of 2022 when we started offering the ESG pool, which we'll get into a little bit more. And it's been the main pool. This is the subject of our investment policy statement, and is under the guidance of our investment committee. The investment committee is made up of professionals within Alaska, many of names which you would recognize, and they help guide us along with a professional investment advisor. And that advisory team is a company called Makita, Meketa. You can look them up on the internet, but they manage about $2 trillion with a T of institutional funds across many, many different places. So our long-term pool's asset allocation consists of 5 main areas. Global equities, those would be stocks, and they are often the primary source of returns within the portfolio. While they have that higher return, they also typically carry much more risk with them than other associated or non-associated investments. And that also includes private equities and some potentially, I'm going to call them hedged equity investments. That means investments that don't really correlate with the regular public markets. Global fixed income, those would be bonds and interest rate and credit investments of some kind. Those are often intended to offset the volatility that comes along with equities. It doesn't always work that way, but sometimes it does. And it provides a little bit of deflation protection as well. And those would be both public and private investments as well. Real assets is another one of our areas, and that would be assets. Those are things you can touch: real estate, natural resources, infrastructure, and those house about 9% of our portfolio. Diversifying strategies are old words, hedge funds, but most importantly, investments that are non-correlative to the markets, which means that they work in a fashion that doesn't work the same way as the market. They might be venture capital investments. We have one, for example, that is a private investment that's in an entity that provides refrigeration warehouses that are across the globe for very, very large organizations which need to refrigerate and or freeze their products. And that entity has, as an example, a very unique business strategy, which is a warehouse contains carbon monoxide, which of course is poisonous to humans, but it's a very efficient storage process because of that, and it could save enormous amounts of money on power. And so some of these very large entities are very interested in that because the cost savings alone pay for their warehouse. So that's an example of a diversifying strategy that works outside of regular public equity markets or public fixed income markets. And then there's good old-fashioned US dollars and cash. We keep some of that around to help us with liquidity concerns within our own organization or within the funds that we hold. We have about 2,500 of them, so there's activity going on every day that we have to keep some cash around for, especially when you guys decide to make a grant out of your fund. And we also have to be able to meet private either equity or debt capital calls within our private investments. So you'll see that there's a reason we keep about 2.5% in cash. So the long-term pool, the emphasis of that is long-term growth with a diversified risk profile. Again, it's the main strategy of the IPS and the investment committee. Let's take a look at our returns for a little while. So the returns for the long-term pool as of 12/31/2025, you can see there our portfolio returned 12.47% last year in 2025. Over a 3-year period, it was exceeding 13, and over a 5-year period, 7.64. We measure that portfolio against 2 different benchmarks. One of them is the balanced index. Is sort of like a 60/40 old conventional portfolio. It includes a little bit of Treasury inflation protected securities or TIPS. So you'll see that it contains 60% world stocks. It contains 30% bond aggregate index and a 10% TIPS. That's the balanced index. The other benchmark there on the screen, the one called investment objective, is one that reflects benchmarks that are specific to each of our underlying investments. We have, well, hundreds, but within major categories, we have those benchmarks, and they roll up into this sort of aggregate one. And you can see that it has a different style from the others, but you'll see that we're exceeding that over the 5-year period, which is our goal. And you can see that it changes as of March 31st. Don't know if you follow the markets every day, but March was a terrible month for us. April rebounded. So, hang on, stay on. There'll be more about that later, but you'll see that March, through the quarter to date, we had a negative return within our portfolio, and it pulled down the overall metrics over the 5-year period. That you can see that were different in December. But those are returns for the long-term pool for that period. Let's move on to the environmental, social, and governance pool, which is quite a mouthful, so I'll call it the ESG pool. And what exactly is that? Well, we began offering that pool in 2022, as we talked about before. ESG stands for environmental, social, and corporate governance investing. It's investing with a purpose. You're trying to find investments that meet certain criteria, and you're going to judge those investments based on how well a company performs within some of these criteria. What are those criteria? Environmental, how does a company perform as a steward of nature? Social, how does a company perform within managing its employees, its suppliers, its customers, and community relations? Governance, how's a company's transparency demonstrated in reference to its board, its governance, executive pay, shareholder rights, and a number of other things, audits, for instance. And how does it do that? Well, we'll talk a little bit about how those things are being examined within the ESG potential. So the universe has every investment, of course, there possibly could be out there, but it uses 2 different screening tools when determining whether or not that investment or entity will be included or excluded from the potential pool. It uses positive screens, which positively address ESG factors. It scores on 3 factors of environmental, social, and governance. And that would make you more inclined to invest in that entity if you were part of that pool. A negative screen is the opposite. It uses specific exclusionary criteria to eliminate entities from consideration, such as civilian firearms, controversial weapons, oil sands, tobacco, things like that. And it uses some screening mechanisms produced by independent parties to take a look at each of these potential investments. How is that asset allocation structured? Well, you remember the one from the traditional long-term pool. We had four major classes plus cash. The ESG pool is pretty much a 60-40 conventional portfolio. And it's not got any major differences between that. Occasionally they have a little overflow in cash and it'll make that differ a little bit, but generally it's trying to keep to that 60-40 split. If you want to learn more about it, you can. So our ESG pool consists of something called a ticker symbol. If you like playing in the stock markets, you can Google this ticker symbol. It's EAOR, or EOR as I like to call it. EOR is a simple way to invest in a fairly diversified portfolio. You might be able to tell from this screen that EOR is a wrapper around different other ticker symbols. This is it's a big BlackRock mutual fund. BlackRock is a giant financial company that provides different investment options to the world. But this particular EOR is a wrapper around 1, 2, 3, 4, 5 different other ticker symbols that are a portion of that EOR, and a number of holdings within each of those. So as an example, the first ticker on the list there is ESGU. That's consisting of large to mid-cap US stocks. It has 287 entities within that particular ticker symbol. And I won't bore you with going down the list, but you can see that there's large and mid-cap stocks and small-cap stocks and investment-grade bonds. And this is global in nature. So it can change the performance characteristics a little bit versus our long-term pool, which has a tilt towards US, although it does have an international component as well. So why EOR? Well, it's a fairly diversified, sustainable portfolio. Its objective is to track the investment results of a number of different entities. You could see from that previous slide that there were a whole bunch of them. And it uses that screening tool to make sure that these entities fit within its purpose. So remember, it's a diversified, sustainable portfolio based on that ESG lens, and it's investing with a purpose. Oftentimes, that means your returns are going to be different than that long-term pool, which is more diversified, but also aren't necessarily screened for ESG characteristics. Here's what the ESG portfolio looks like in terms of those same two timeframes, December of 2025 and March of 2026. Inception is pretty brief for this particular fund because we only brought it on in July of 2022. So you don't have a whole lot of history with this one like you do with our long-term pool. But you can see those returns have been pretty substantial. 15% last year. That beat our long-term investment pool, which had 12.47. And then you can see that the 3 years and the 5 years. And then again, our friends didn't do too well in the first quarter because of the market changes and the challenges the market was experiencing. And so that pulled those returns down as well. So in summary, we have three pools. That short-term pool, which is designed primarily for monies that you intend to spend out fairly quickly, or that you're not comfortable taking equity and public market risks that might result in a negative return. Again, it's not really appropriate for a long-term endowment perspective because the returns won't be sufficient to even potentially keep in front of inflation, which of course you want to do. The long-term pool, that's that larger one with the more diversified portfolio, and the ESG pool, which we just talked about. So now let's talk about why we do what we do in investing here at ACF and the horizons that we like to talk about. So the long-term pool, it is, remember that it was long-term in nature. The time horizon is pretty long. By that, I mean greater than 5 years, and really you ought to think about 20 years. If you own an endowment here at ACF, then you should be talking about time horizons that look more like 100 years because endowments are supposed to be here in perpetuity. So long-term time horizon means different things to different people, but remember why we're here. And that's to have these investments help grants in the future as much as they do today. Since that investment world out there is volatile, we know there will be fluctuations. I can tell you that our portfolio in the month of March went down more than $10 million. And in April, it went up more than $10 million. So those kinds of fluctuations will happen. That's in a 2-month period. And we're talking about investment horizons that are far, far longer than that. So remember that those things will happen and that we need to take a look at the world in a different lens than just day to day or month to month. So let's talk a little bit about some historical perspectives, market volatility. So a common measure of the public equity markets in America are the S&P 500. Standard & Poor's 500 index is one that's been watched for a long, long time. And from 1926 to 2025, a 100-year period, it's delivered a rate somewhere between 9.8 and 10.3%, depending on who you believe, across an annual basis, on an annual basis. But here's a trivia question. Over that same period, how many times do you think that return actually fell between 9.8 and 10.3? I'll let you think about that for a second, but here's the answer. Only once. And that was in 1993, and it was 10.08%. To widen that window a little bit, if you go from 8 to 12%, it only returned 8 to 12% in 8 of those years. It's all over the map. And that's the point about volatility within the markets. And I'll give you a visual of that right now. If you look at this graph, some people like visuals, others like tables. I'm an accounting nerd, so I like numbers. But here's a picture. The green ones are positive returns. The red ones are negative returns within the S&P 500 over that 100-year period. And you can see the wild volatility. The little dotted blue line is 10.1% average over that time horizon. It rarely falls anywhere even close to that, as we just talked about. So you can see that massive volatility. What you will notice potentially is there are more green marks than red. And if you did the numbers, you'd find out that 74% of that is an average positive year. And that average for those years, the 74% that are positive, is 21.14%. The average negative year occurs only 26% of the time, and it's only average a negative 13.4, if you want to be exact. So not only are you actually coming out ahead in the quantity of green marks up here, but you're also, the intensity of the green marks is higher than the intensity of the red marks below. Here's another graph that shows you some major things that have happened over that same 100-year period, the Great Depression, where it did go down quite a bit. You can see that right here. World War II, the Korean War, the Vietnam War, the oil crisis. How about the tech bubble of 2001? How many people were invested in tech stocks back then? COVID. You can see there are little blips along that same 100-year period. And by the way, if you had thrown $1,000 in the S&P 500 in 1926, it would, and reinvested all of the dividends and earnings from it, it would be over 1.9 million today at the end of 2025. So it gives you something to take away in terms of time horizon. Let's talk about the S&P historical perspective. Time is your friend. When you looked at those historical returns, the number of green marks were there. There was 74% chance of success. Go to Vegas and see if you can find that. I probably can't. Uh, and is there a way to manage that volatility, though? Some people worry about that, can't sleep at night. And the answer is yes, there is a way. And you do that uh, with diversification. We've talked a little bit about what that is already, but you're basically building a portfolio of complementary assets and that don't always perform in that same way. And that's why that long-term portfolio that we have is built the way it is, because that structure gives it an ability to survive downturns that may be happening in parts of the portfolio, but not everywhere. Modern portfolio theory is grounded in something that is pretty interesting. That diversification is part of it. The asset allocation model is part of it. But the idea is that owning those different kinds of financial assets is actually less risky than owning just one type. And I guess the old saying about keeping all your eggs in one basket probably is the one that they were working with when they posited that years ago. Uh, and I'll give you some graphic indication of that. You have a couple of three curves here on this marvelous graph, but what you need to take away is the return is on the left side of the graph going up from 2 to 20%. The risk piece of the portfolio is on the bottom. That's measured by something called standard deviation, which I won't bother to get into, but the more the standard deviation is there, the more risky it is. It moves around more. And you can see that the dark blue curve is US bonds and international stocks, a portfolio made up of just that. US bonds and US stocks is different. That's the little light blue one. And you can see that the return actually depressed there based on the difference between the dark blue and the light blue lines. But it did move back a little bit in risk, which is interesting. But then when you add US bonds, US stocks, and international stocks, or all three of those, that's the green line. And all of a sudden, you've moved backwards in risk and still are hitting pretty much that same expected return. And there's something called an efficient portfolio or efficient time horizon that looks at that overall and says, oh, that makes sense. And if we do that, we'll actually decrease risk, but keep our level of return where we want it to be based on the risk we're willing to accept. So let's get back to our long-term pool. I'll just throw that slide up there again. It's structured using that diversification and modern portfolio theory. You can see the percentages there. Presumably, you might even do some of this in your own 401k plan. So investing 101 is what we kind of just went through, but time is your friend. The longer your time horizon, the more likely you have those positive results. Remember that you had that 74% chance. That equities are still part of that overall strategy. They should be. They have the highest return historically. They're also more volatile. But that we learned a little bit about adding asset classes will actually make and improve your portfolio, make your returns better potentially, as well as reducing your risk. So I'm going to give you a little couple of thoughts to end with here in terms of investment strategy. There's a very famous guy named Jack Bogle, started the Vanguard Group, Vanguard funds you might have heard of, or maybe own some of them. But he summarized what really drives stock market returns. He said two things: fundamentals and speculation. Speculation equals investor sentiment based on the positive and negative surprises that happen during a period. That's how he defined it. Fundamentals, however, are dividends and earnings. So looking at the S&P 500 in the quarter one of 2022, 78% of the companies beat the earnings per share. Year over year, it posted an EPS growth of 4.4%. Over the long run, Jack said, well, speculation washes away. That's those surprises that are happening during a period. And what matters in the end is dividends and earnings. So you can take some solace in knowing that the model portfolio ACF has is doing its thing. It's delivering dividends and earnings across a diversified platform. Risk and return are tied at the hip, but capturing the returns that stocks and bonds deliver is not easy. It requires adhering to a disciplined strategy during good years and bad. There's another fellow out there, David Booth, the founder of Dimensional Fund Advisors. He said at an industry conference, the important thing about investment philosophy is that you have one. ACF has an investment philosophy, the IPS, and we don't waver when it comes to the conviction within that philosophy. So remember what your options are. You have the short term, the long term, and the ESG pool. There is that selection window that Celeste talked about early in the conversation here. You can go for 60 days and you can elect one of those three pools. And there's a form to fill out. I understand that was emailed to you in the earlier email when you registered for this, but there it is. So if you have any questions, we can talk about those.
I didn't see any questions in the chat, Kevin, so you can come off mute if you want to ask a question.
Heather, I see you talking, but I think you're still on mute, so I can't.
Yeah.
Yeah. I don't know if. No, we still can't hear you. Well, does anyone else have questions in the meantime? We can see if Heather can overcome the mute button, wherever that happens to be on whatever device she's using.
I had a general question about dispersals, and I don't know if this is the right time to ask that.
Well, since no one else has asked one, go ahead.
So our fund at the Running Club North has some disposable income, I believe, and we have 2 scholarships that we offer each year, and we're moving to have this particular fund pay for those scholarships. So I'm not familiar with the process of how that happens.
So are your funds endowed here? Do you know?
Yes.
They are. Okay. So we have a terrific session called the Agency Information Sessions, which we hold quarterly that will run through an entire slide deck for that, but I'll give you the brief version. Yeah, Heather, we can hear you now. Just let us answer this question from Pete first. So in essence, what happens is that every year the board of directors decides on a percentage that will allow endowments to spend. For 2026, that was 4.25%. They have to consider a number of factors, which I won't get into, but essentially a number of factors to consider what that responsible spending or prudent spending policy would be. We then multiply that by a 16-quarter average of your fund's balance. The reason we do that is to smooth out those crazy market fluctuations I just talked about. And so we use a 4-year average and we multiply that by that 4.25%. And that would be the amount you're allowed to spend for that year out of that fund, assuming that it doesn't pull your fund down underneath the principal, which is the sum of all the contributions that have been made to the fund over the history of the fund. So essentially, that's the mechanism. Every year, if you don't spend that, it will add to itself, and there will be something called a spendable balance that you can see on your statement, the quarterly statement, or at any time in your portal if you have access to the donor portal, which you should have.
Mm-hmm.
Did that explain that sufficiently?
Yes. Thank you.
Yeah. And then simply, if you want some of that spendable balance, you can, in the portal, you can request a grant to yourself in whatever amount you want, whether that happens to be the spendable amount or something less. You're welcome to do that.
Thank you.
Thank you, Kevin. I'm sorry I had apparently clumsy fingers. I
So
have
good.
I have two questions. My fund is there very small, so I don't really have to think about that this much. However, in my other investments, I am very clear that, no guns, no tobacco, no arms. If you are in the long-term pool, how would I know whether it excludes those things that I absolutely do not want included in it?
Well, it does not, and it's not necessarily intentional that way, but let me give you an example. The S&P 500 contains many entities that would engage potentially in some of those. As an example, Boeing.
Mm-hmm.
They certainly make machinery that is utilized in warfare. They also make airplanes we fly on every day. So it wouldn't necessarily be excluded based on those principles. But it might be in the ESG pool, depending on whether or not that is a negative screen that would be appropriate. If, as an example, nuclear weapons would be one that I know is excluded within the screening in the ESG pool. Boeing doesn't make those that I'm aware of, although maybe they do. And so then it might not necessarily survive the negative screening, but then it would be judged on the other ESG factors. So on the positive side, so whether they contribute nicely to the community, whether or not they're socially transparent and so on.
Okay, thank you. That's what I wanted to know. And I know that some companies either merge or change names. I remember Altria snuck in there before people realized that it was a tobacco company. But my second question is much more down to earth. You keep a certain amount of cash. Where is it? Where's it deposited?
Well, we keep it all over the place intentionally. We try to spread the wealth to some degree, but it depends on it. So that short-term pool I referenced has between 18 million and $20 million in it at any one point in time. That is kept in a trust over at First National Bank of Alaska.
Thank you.
Uh, we have in our long-term portfolio about 2.5%. As of March, I want to say it was about $10 million. And that's in a company called Principal Financial Group. That's our custodian. And it's in a money market environment as well. But that's short-term cash that's sitting there either to meet investment potential needs through rebalancing or something like that, or capital calls that come in through our private investments.
Mm-hmm.
And then we keep operating cash in North Rim and First National Bank of Alaska here locally. And we actually have some accounts over at Wells Fargo that have some small amounts of cash in it as well.
And basically, your operating cash makes payroll and payables?
Payroll, payables, and our grants that are given out weekly. Oh. Yeah. So last year, for instance, I think we granted about 26.5 million. So we have a continual cash drain that is happening based on the grant making that's going on.
Thank you very much.
Sure.
We've got some questions in the chat, Kevin, that I will read out loud and then see what we can get from an answer. So when you refer to the amount the funds have made, such as the different percentages in the long-term fund and in ESG, Susan's question is, so that is the fund. So the fund makes that amount minus the ACF admin fees and then the custodian fees. That would be correct. So it's that amount, but that amount doesn't take into consideration minusing the ACF's admin fees.
Correct. So the returns that we showed you on those slides are net of investment fees, which are part of the overall investment portfolio. On your statement, those show up in two places. The earnings show up in actually three lines: unrealized gains and losses, realized gains and losses, and dividend and interest income. And then there's an expense line that shows on your statement as well, which is investment expenses that are associated with our private investments, our investment advisor, any fees that we pay for the custodial fees or investment manager fees. All of those, but that percentage return that you saw is net of all those fees that would be disclosed separately on your quarterly statement in your fund. That is correct. The admin fees or the foundation fees that we charge you, those are shown as a separate line item or row on your quarterly statement as well, but those are not reflected in those investment returns that we showed you.
And then just a follow-up, kind of skipping down, just a follow-up. So no cash is currently kept in a credit union.
Correct.
Okay. And then I can answer this one, kind of tagging on to Susan's question. Where does it show what kind of fund? So what investment pool the fund is in. So that is typically documented in the fund agreement, whether it's going to be a short-term or ESG, because the default that many of our funds are invested in is a long-term investment pool. And so if you wanted to move your fund into the ESG or short-term pool, we have you fill out a separate form, and that form can be found on the fund portal if your organization or you as an individual has chosen to do ESG or short-term.
And to give you a preview of what's coming sometime in the future, we're redesigning our quarterly statements a little bit, and that would actually be reported on that new format. So that has been a request, and we're in the process of doing that. It's not done yet, so it's not ready for prime time, but that is on the list.
And I have another question from Joe, which is what % of Alaska Community Foundation's total investment is in ESG, is in our ESG portfolio?
There's about $6 million in that particular portfolio at the end of February, and there was about 225 million in the long-term pool, and there was about 18 million in the short-term pool. So if you wanted to add all three of those together and figure out the reflective percentages, you could, but that gives you some idea of the popularity. Now, remember that the short-term pool, it carries probably a different purpose with it, as does the ESG, than the long-term pool. So the short-term pool, again, is designed for short-term money expected to be spent out over some short period of time and doesn't want to take on that market risk. The ESG pool and the long-term pool are longer in nature, but ESG pool is designed to meet some of the specific criteria that we talked about and that Heather actually asked the question about.
Not seeing any more questions in the chat, but yeah. Oh, here we go.
Thank you for doing such an excellent professional job.
You're welcome.
So, Kevin, I have a question.
Yeah.
And thank you for all this. And I apologize, I tuned in late. I hope I'm not asking a question you've already covered. But my question to you is, I work with a couple different organizations that have asked you to be the supervisor of our funds. And our organizations have the attitude that we're never going to die. And so, right? So, I mean, I'm going to die, you're going to die, everyone's going to die, but our organization's not going to die.
Mhm.
And so, my question to you is, there's lots of advisement to individuals as they age, how much to put in bonds and how much to put in equities. If you're never going to die, should you ever put any money in bonds?
Well, that's a great question, and I'm, I think it really depends on your stomach for risk, right? That diversified portfolio, which I can scroll back to that screen here somewhere along the line, but our long-term pool is really designed to try to weather the storms far more than I'm going to call it people that can't sleep at night when you have 100% of your portfolio in an equity environment, right? You can see here the portfolio structure is 53.5% in global equities, 25% in bonds or fixed income related, credit related, debt related instruments. It certainly, I'll give you one point of view. Our friend, Mr. Warren Buffett, who's a pretty famous investor, I believe his estate plan for his wife and children references two investments, 90% in basically an S&P 500 index fund and 10% in cash. So he took what you're describing in terms of risk and said, I'm okay with that. He clearly has enough money to not have to worry about it if it takes a fall. But part of what we toy with here is trying to balance grant making that's coming from these perpetual funds, endowments, right? And the need that the entities that those endowments support to not have a wild fluctuating amount all the time. In some years, the markets have cratered 20 some odd percent. And all of a sudden, if you're counting on that distribution to fund your operations within an agency and it's trimmed by 20%, that means you have to trim your operating budget by that next year. That's a pretty healthy decline that would be difficult to absorb by most nonprofits. So we try to balance that risk and reward to the extent we can to take some of that fluctuation out. But we also recognize that you have to stay ahead of inflation, and you have to stay ahead of trying to make it more possible to do more things within the state of Alaska. And that's why the investment policy is structured the way it is. I will say that recently our investment committee has started to take a look at more private investment. Certainly there are pluses and minuses about that, including some of the valuation in the public markets, but some of that valuation is a hangover into the private markets as well. You want an example of that, check out SpaceX. So, there are valuation concerns always. There's equity and fixed income. Certainly bonds play a role. It used to be that they played an offset role pretty standardly with equities, that you could, if equities went up, bonds went down and vice versa. But that's not always true anymore. And it certainly isn't true in an interest rate environments that we've experienced in the last 2 decades. So I guess that's a long way of saying I think it really depends on your tolerance for risk. And here we've really tried to define a reasonable growth strategy, but not one that is going to hit a home run when the markets are there. But it's also not going to take a significant loss. It still will take an equity loss, but it won't take one as bad.
Thank you.
Sure.
Kevin, would you expand just a bit more on the private market issue? I have been reading a great deal recently and listening to a lot of borrowing taking place from other than the traditional regulated, I'll call them banks, but regulated organizations, and out seeking greater returns from those resources that may give a greater return, but have the risk of not having the regulatory framework.
Yeah, you're referring to the private credit market, which is a bit suspect right now. Interest rates changing the way they have created some of that. I'm going to call it Jack Bogle's description of enthusiasm being a little bit a part of it as well, where it's the shiny new penny and everybody's jumped on it over the last decade, and now there might be some structural problems with it. You might remember the 2008 financial crisis, which ended up being a global one, but was primarily driven by derivative investments within the U.S. mortgages, having been overly remarketed, if you will, in the non-regulatory environment or one that was less regulated. And pretty soon that portfolio of investments was so diluted that any sort of change had a major ripple effect across markets. And you're seeing some of that in the private credit markets. Private investments oftentimes are both private equity and private debt. We own some of those within the portfolio, and we've been mildly successful with that, but we also don't put a giant percentage into them for some of the reasons you described. The other reason is that due diligence to decide that this private equity or private debt entity or fund of funds or whatever it is you're investing in is an appropriate vehicle is a very heavy diligence burden that is difficult to achieve with the amount of money that even we have in the portfolio. And the other piece of it is that over time, you're locking up your investment for a fairly long time horizon, generally about 10 years in the private equity space, where you have this initial funding that you're going to be calling the capital calls. You have a harvesting period where you're harvesting the monies that are coming from it, and you have an escape hatch at the end of it where you're transiting out of that and there are distributions coming back out of it. But you have that longer time horizon where you're locking up your liquidity. So you have to be careful not to over invest in that area and then end up in a liquidity crunch of your own and having either fire sale investments or worse yet, not being able to perform under the circumstances that you've committed to. In our case, that would be grant making, right? So
Thank you, Kevin.
sure.
I don't see any more questions in the chat. And I don't see anyone else coming off of mute. So we may give you back 7 minutes of your time. However, once again, this session was being recorded. We will share this out after it's rendered and also include additional resources like our investment policy statement and that form you can fill out should you wish to swap your fund from one investment pool to the other. You can do that starting June 1st, and you have until July 31st to make that decision. Thank you so much for joining us on a Wednesday evening from wherever you are tuning in. And we will talk to you very soon. And please feel free to reach out if you have any questions or if anything comes up after this session.
Thank you,
Thank
everyone.
you. Thank you.